Hi, this is Hannah Cole from Sunlight Tax. The key piece of information that you need to understand to really unlock managing your money is basically a whole third category of money that you probably never thought about before. So I think a lot of people tend to think inherently about two kinds of money in their business. That is income to the business and then expenses that you make from the business. Those are both true. However, accountants know, and in fact take many, many courses on, a whole third category. And this category is called equity. But you can think of equity as investment. Basically, equity or investment in your business is not income to the business because it's not generated through the operations of the business. So if I sell a painting or I do services, I have a client pay me for services that I provide, that's income that I get to my business. However, if I take money and move it from my personal bank account into my business bank account to pay for a big new piece of equipment or my first security deposit on my first studio, that is equity. That's an investment in my business. That's not income coming into my business through the activities of the business. It's simply an investment. Also very important to note that it's not taxable because I'm moving it from one bank account of mine to another bank account of mine. So for that reason, it's not a taxable moment. Whereas if I earned money from sales of paintings, that would be a taxable moment. That would be income to my business. So one of the major things that kind of unlocks your money is separating your business and personal bank accounts. This is a really key, important thing, and I'll tell you all the reasons why it's so great. When you separate your business and personal bank accounts, what you do is you create a business account that is solely for recording the activities of the business. You deposit all the income you make from the business into that account, whether it's through direct deposit or just cash, depositing your checks into that account. But you also pay all of your expenses for the business out of that account. You hook up a credit card and you pay it off with that account, or you use the debit card from that, or you write checks out of that account. Super, super important. When you do that, what happens is the transaction history from that business bank account becomes a wonderful, reliable source document that is the basis of good bookkeeping. And then essentially all you need to do is hook up a bank feed, which is now a pretty easy automatic process you can do with most bookkeeping software. You hook up the bank feed, in other words, all that income and expenditure activity happening out of that business bank account, you hook it up to bookkeeping software, whether that's QuickBooks Self-Employed or Wave Accounting or Xero or FreshBooks, Peachtree, Sage. There's a lot of them. You hook that feed up to your accounting software, and now you have all those transactions automatically coming into your bookkeeping software. And all you have to do to keep things straight and to start your bookkeeping is categorize them. You just sort those things into the right categories. One awesome thing is it means you'll never miss a deduction again, because now you know that you're only making business expenses out of that business account. So now if you forgot one, that happened in January and now it's April of the next year and you're getting things together for taxes, if you made it out of that account, it was a business expense. All you have to do is think of the right category. And most bookkeeping software these days is smart and teachable. So once you go to, say, Cheap Joe's Art Supply 3 times, and you categorize that every single time in your bookkeeping software as a supplies expense, your software starts to learn that Cheap Joe's Art Supply purchase is always a supplies expense. And you actually don't even have to categorize it anymore because your software will start to do it automatically. This is one of the beautiful, magical things that happens when you have bookkeeping, but also when you have a separate business bank account. Another important reason for the business bank account is because the IRS already expects you to behave that way. The IRS expects you to have a separate business bank account. And so for your own protection and for the fact that the IRS can actually compel you to show that account and the separation of it, it's a good idea to have it. And third of all, for liability reasons, it's very important when you have a business, especially as a sole proprietor, where there doesn't appear to be a big distinction between you, the person, and you, the business. The more separation you can put between those two things, the more protection you have in a lawsuit. If somebody wants to sue your business, your protection is all about keeping that business really tight and keeping it over here as a business and not as mushy business and personal life all mixed together. So yes, the IRS already expects you to keep it nice and separate, but also if you form an LLC it's not a tax entity that has actually nothing to do with your taxes and makes no change on your taxes, but it is a legal protection. That's a great idea and a great thing to do for liability reasons. And the function of an LLC is actually to take you, the human being, you, the personal person, and separate it from you, the business. It creates what's called a corporate veil in between those two things. And one of the requirements when you have an LLC is you separate the personal activities and the business activity. And having a separate personal bank account and business bank account is one of the key moments there, one of the key protections. Important to know that actually if you have sloppy accounting where you commingle business and personal expenses in the same account, you can invalidate your own LLC. You can waste all that money you spent with the lawyer and the annual filing fee, because normally how an LLC protects you, if you do something, if you screw up in your business and somebody sues you, if you didn't have an LLC, if they sue you, they can come after all your assets, business and personal. Now, for most Americans, the majority of our assets are in our personal life. Most people's major wealth is on the personal side, not the business side. So your 401k, your retirement, your kids' college savings, your house, your car. In a business, I'm a painter. So in my creative business, what do I have? I've got some easels. I've got maybe a printing press. I don't actually have a printing press. I've got a bunch of canvas. Maybe my computer is the most valuable asset that I actually have in my business. Basically, if you sued me as a painter and could only come after my painting business, you just would not get very much. There's not much there except paint and canvas. So however, if you sued me, the person, there's quite a bit more, because that's where most of my personal wealth is built up. Now, an LLC will protect you from having those personal assets be up for grabs in a lawsuit, because I created that shield in between them. However, if I commingle my business and personal expenses in a single account, now it actually means a court can pierce the corporate veil. They can actually compel me to show my bank records. They can show that I mix my business and personal, that they're in fact not separate like the LLC says they are, but they're actually the same thing. And now I'm open to that lawsuit. Now that lawsuit cannot stop at the door of my studio. It can come right in the front door of my house. And now it can go after my house, my kids' college fund, my retirement, my car, etc. So sloppy accounting is riskier than you thought it was, and good accounting is more beneficial and protective than you realized it was, probably. So those are the major reasons to open a separate bank account. It creates a magical opportunity and record for your bookkeeping, so bookkeeping becomes seamless and easy. It creates a liability protection for you and helps you keep separate your business and personal assets. And now you know why that's such a good idea. The other component to having a separate business bank account and personal bank account and understanding equity and investment is, how do you pay yourself? So as a sole proprietor, freelancer, the right and proper way to pay yourself is actually to make a transfer from your business bank account to your personal bank account. Now, I know I've said don't commingle, and yes, that is absolutely true, but moving money back and forth is okay, and that's where that third category in accounting comes in. So moving money from one account to the other is an equity transfer. It's a movement of investment back and forth. So if you move money into your business bank account from your personal account, that's an investment to your business. It's called an owner's equity transfer. You're putting equity or investment into the business. Say you do that, most businesses start that way. So most businesses require some little nut of money to start before there actually is a business that exists that can make its own money from its operations, right? So intuitively, you probably have an understanding that money is required to start a business before the business itself has an ability to generate its own money. However, you probably understand the importance now of not moving money nilly-willy between the two accounts. It is important to do it in a certain way. So you never, ever, ever want to pay for personal expenses out of your business account. That is the kind of mushy transaction that can invalidate your LLC and get you in legal and financial trouble. However, moving money, nobody starts a business just to build up a huge pile of money in a bank account they're never allowed to touch, right? I think intuitively we all know that too. So the way that a freelancer is meant to pay themselves is, of course, you earn money in that business bank account, and then you make a regular periodic draw from the account and transfer it to your personal account. So this just means you take a chunk of money and you move it from the business account to the personal account. In your bookkeeping, you call that an owner's draw. That's how you pay yourself. And that's completely proper, and that is what is expected of any freelancer or sole proprietor. Thank you so much for watching. I hope that helps. And now my next challenge step for you here is, if you haven't done it yet, now you understand the reason why it's so important to open a separate bank account for your business activities. So my challenge for you is right now to go out and open another business account. Thanks so much for watching.